Hey friends, in this video I'm going to go through Australian Foundation Investment Company's FY22 results. I'm going to give you a couple of takeaways because the actual full presentation was 50 minutes long, including Q&A. And I just want to do a quick summary for you. The reason I like listening to their presentations and also doing a bit of summary for myself is because they are the third largest holding I have. They're about 14% behind VGS and VAE. I also find it's very handy to listen to these professionals. I cannot stress enough the value of listening to investment professionals talk about their journey, their portfolio, the reason they made transactions, their view on the economy, even though they don't really try to go into too much detail because I see them as individual businesses. Just very handy to listen to. Even if you don't hold shares in AFIC, it's worth listening to these people to hear what they say and to listen to the way they think about how they invest. So hopefully you'll get some value out of this. I think you generally will. So let's get into it. Now, if you don't know AFIC, let me give you a very high-level snapshot. In the past, I've said they're like an ETF, and people in the comments section they've had a go at me for saying that, saying, how can you say that? It's not like an ETF. Here's what I mean. When you buy shares in AFI or AFIC, the code is AFI, you're effectively buying shares in a company that has holdings in other companies like BHP, like CBA, and all of that. It's the same thing, conceptually speaking, as buying holdings or shares in VAS or Vanguard's Australian shares or A200, Beta Shares 200 shares index, because they also have holdings in the top 200 companies, which probably includes CBA, BHP, FMG, all of those people. The difference is AFIC has people looking and making the decisions on whether to buy the shares, whereas the ETFs just follow the list of ETF holdings that the index says it should hold, and it rebalances every quarter or whatever it is. So it's similar in that sense. Obviously, they're very different. Components are different, but conceptually, you hold a holding in a company that has holdings in other companies. Now, the reason why you might have AFIC over an ETF, I'm not saying it's the only reason, but the reason why it might be is they try to pay steady dividends while also trying to achieve capital growth. So they try and do both. Often you try and get one or the other, but they try and give you both capital gains in terms of the value of each share going up, but also steady dividends so you can potentially retire or rely on it as a source of income. Whereas ETFs just kind of track the market, and sometimes the dividends might go up, sometimes the dividends might go down. It's really out of their control and out of your control as well. Quick touch on the results. FY22, the headline items were obviously profits were up because everyone's paying more in dividends. However, the total amount of earnings that they got from dividends was not enough to pay out their total dividend amount of 24 cents. So they've had to dabble a little bit from the reserves to pay off the total dividends and to hit the 24-cent target. Now, they have plenty in reserves. The comments from Jeffrey Driver was that they have plenty in reserves for the future, but they just wanted to call that out. The other thing was the management expense did tick up a little bit from 0.14% to 0.16%, driven by the fact that they have slightly more imagined salary coming through for their international investment team for the portfolio, and also the size of the portfolio went down in general. So the classic case of the numerator going up, the denominator going down, so the percentage number went up from 0.14 to 0.16. Really, I mean, it's fine. They're running fine. I wouldn't look too much into this. There was a bit of commentary on dividends actually in the Q&A. I'll get to that later. And against the comparison of the accumulation index, they're also going fine, especially considering the number that they show is after tax and after fees, whereas the number you see on the index is before tax and before fees. So it's probably going to be pretty reasonable, especially considering that they try and give you steady dividends if that's something you're looking for in terms of either now or in the future. Quick comment on the NTA. So this is essentially saying it's currently running at a premium, which is another way of saying that if you buy it now, you're essentially paying $1 for 90 cents worth of value. So you just got to be conscious of that. You're kind of getting ripped off to do it. It's a great purchase, but you're getting ripped off. You generally don't see this with ETFs because they try to keep that disparity quite low. But with LICs, they don't try to manage that. So you can have situations where you're paying more for actual underlying value. You can also have the reverse occur where you pay $1 for like $1.10 worth of value. That's where it goes below 0%, and it's essentially negative. But the key call out is currently sitting at a premium, and it's been sitting at a premium for a while. Now, this is the exciting stuff. This is the stuff that I live for. Not live for, but this is the exciting stuff that I want to hear from them, where they talk about the portfolio and talk about the stuff they've been doing. So this is a nice little diagram which they threw out to show you what a good balanced portfolio from their point of view tries to look like and what their portfolio looks like. 4 key categories. Growth companies. Companies that they're still expecting either from they're reinvesting their profits and they're expecting either capital growth, or they're just expecting these companies to continue growing in terms of earnings per share in general. Then you got the stalwarts. These are companies that are just steady. They've got great moats. They're always probably going to be in the portfolio. They just keep generating good returns. You got your income companies. These are usually your banks and Telstra, classic. They're making good dividends. So basically companies that probably generate more than they need to keep investing in their own business. So you'll see that they'll probably pay out 70, 80, 90% of their profits in dividends, and they use those dividends, AFIC uses those dividends to pay on to us. And then you got your cyclicals, the classic MITRE. So they'll go up and down, they'll stay in the portfolio, there'll be periods where they're performing very well in the market, there'll be periods where they're not performing very well. They'll probably follow the general cyclical nature of commodity cycles, iron ore prices, whatever it is. Good to have in your portfolio as well. They'll help maybe make up losses in other areas. Key call out is, you might have done the maths already, this percentage accounts for 99%, and I think the other 1% that's missing is the international portfolio that they started a couple of years ago. The next slide that I also like is when they actually talk to you about the stuff they did in the period. So they got rid of a couple of companies and they talked about this. They said it was because of either the competitive landscape has changed or there's been structural changes in the industry that could have an impact on the value of holding these holdings. So very complicated stuff, but they got rid of them. And in the case of Milton and Sydney, those companies got taken private, so they basically disposed of their shares, or the shares got taken off them anyway. They got money for it. It wasn't like Russia saying, we're taking this company away from you. They got money for it, it's fine, but they're no longer in the portfolio. And they would have redeployed those proceeds into other parts of the portfolio. New purchases and adding to existing holdings. New purchases, they picked up JB Hi-Fi. They've made this comment, I think, in my last video as well. They see it as a great company with a great moat, but also generating great dividends, market leader. Mirvac, similar income play, so dividends, whereas WiseTech was more of a long-term growth play. So interesting to see there. Adding to existing holdings, obvious big names here. The key thing I always like to note is the fact that they had BHP but not Rio Tinto. So they obviously see value in investing more money into BHP, but not necessarily into Rio Tinto. They didn't make money comments. And REA Group, car sales, all these kind of companies. So this is a valuable slide, especially if you're in the early stages of investing and you want to understand how they look at things. It's good to see how the professionals actually comment on and the kind of narrative that they give around why we added to these positions. A lot of value in here. Key thing is that they see these as businesses. So the businesses is great. And if the share price has gone down, they say, hey, the business is going fine. It's just cheaper to now buy the business. Why wouldn't I add this, add more money to the portfolio or add more money to the actual position there? Very handy to hear about. Couple of companies that I didn't see that I thought would have been interesting to have seen. Wesfarmers, Woolworths or Coles. You know, why wouldn't you add to these heavy hitters at these times? But they've obviously decided not to. Maybe the price didn't drop enough for them to see value in adding to them. And obviously the banks. So people are always thinking about the banks, but it seems like AFIC's kind of standing position, this is my commentary, not anything I think that they've actually said, but I think their standing position on this is the banks are great to have, they generate great dividends, but we're not going to buy more of them at this time. I think they're worried about some of the structural changes or some of the structural headwinds that might occur in the future, but the key narrative is they're holding on to them, not making any major changes. Now, I know at this time, some of you might be thinking, hey, Sanji, could I then just replicate, knowing the actual AFIC holdings, could I just replicate this? The answer is, I guess you can. The key thing to know is, though, you don't know the timings of AFIC. They only really report on their portfolio 3 times a year. The interim, the final, which is this, and then at the AGM. So you might not get the perfect timings that they get, but certainly you can try and replicate it. They show it very transparently, the top 25, it's very clear. The weightings are very clear. And certainly when you see these comments about we've bought more of this, you yourself can buy more of these shares as well yourself. The key thing to note is if you already hold AFIC, by buying shares in each of these companies, you're just magnifying your holding in these companies. You're exposing yourself more to that, which may be fine, but that's what you're doing. Because remember, if you have AFIC, you already have a holding in these companies. So it's just something to bear in mind. Then they went into outlook. Not a lot to be said here. They'll continue to invest in good companies at a good price. If the share market wobbles around a bit, they'll use that as an opportunity to buy more or add more into particular companies that they like. Not a lot of moving parts there. The Q&A was where there was a bit of exciting topics discussed, and I'll break it down into 3 key areas. The first was around dividends. So there's a bit of commentary, a bit of questions around, will you be increasing the dividend and will you be creating parity across the interim and final dividend? So increasing the dividend is related to the fact that over time, the dividend amount paid, the 10 and 14 cents for total of 24, has been pretty steady, even through the challenging times. But the share price has been going up, so the effective yield has been sort of tickling down a bit. So the question is, should AFIC be looking to maybe increase? Now, Mark said this is not something that the management team manages. It's obviously managed by the board. So he said they might look into that in the next financial year, but I guess they have to take into account where they think dividends themselves are going and what they want to do for the shareholders themselves. The second thing was around the share purchase plan, so issuing shares. A bit of commentary around, because it's sitting at a premium, it might be a little bit challenging to price it appropriately. The other thing is, if you would do this kind of share purchase plan because you want to use the money to go and purchase more shares, but it sounds like they already are fully invested and they need to know where to put that money. Like, they want to make sure they have a good idea of, we're going to raise this capital from our shareholders and we're planning on putting it into these particular companies. But it sounds like they've already done it. It seems like they're fully invested. They don't have a lot of cash on the standby, but they probably aren't thinking or can't see any areas where they would want to buy more shares in. So again, the commentary from the team seemed to be probably won't do that either. However, if everything falls apart over the next 6 months or the tail end of 2022, they might suddenly come into market and say, hey, we see some great buying opportunities, give us a bit of money, we'll go in and we'll use it well. Let's see. So my final thoughts on this are, I'm not currently buying AFIC if I wanted to. So the algorithm I generally follow when it comes to AFIC is actually, do I want to increase my exposure to Australia, or do I see buying opportunities in Australia in general? If the answer to that is yes, then I have a look at AFIC. I say, is AFIC currently sitting at parity or at a discount? The answer is yes, then I'll buy AFIC. If the answer is no, then I'll probably pivot to buying into A200 or VAS or something that's Australian focused, an ETF that I can get at parity. Hopefully you enjoyed that video, and I encourage you, even if you're not a shareholder, please do listen to the AFIC presentations. It's super valuable to hear from these hotshot Top Gun investors and hear how they think and invest in the market. So I'll see you in the next video. Bye for now.